What is the Clarity Act for crypto and why does it matter for XRP? Today, we're breaking down the legal framework reshaping the industry. Specifically, we're looking at the Financial Innovation and Technology for the 21st Century Act, commonly known as FIT 21. This proposed legislation could redefine how every digital asset in America is regulated, ending years of uncertainty. At its core, the debate centers on a single question: is a digital asset a security or a commodity? For decades, the SEC has used the Howey test to determine if an investment involves a contract where profits come from others' efforts. Commodities, on the other hand, are typically fungible goods like gold or wheat, governed by a different set of rules. Crypto assets often blur these lines, which is exactly why the SEC and CFTC have been locked in a jurisdictional turf war. The Securities and Exchange Commission, or SEC, generally oversees investment contracts, while the Commodity Futures Trading Commission, or CFTC, focuses on commodities and derivatives markets. Without a clear act from Congress, both agencies have claimed authority, leading to conflicting rules for exchanges and developers. This brings us to XRP. For years, XRP has been at the very center of this regulatory storm. In late 2020, the SEC filed a landmark lawsuit against Ripple Labs, alleging that XRP was sold as an unregistered security. The lawsuit sent shockwaves through the industry, causing exchanges to delist the token and freezing its growth in the U.S. market. Critics call the SEC's approach regulation by enforcement, the idea of setting rules through lawsuits rather than clear guidelines. Ripple fought back, arguing that the SEC failed to provide fair notice and that XRP itself is not a security. Then came the turning point. In July 2023, a federal judge issued a summary judgment that changed everything. The court ruled that XRP in and of itself is not inherently a security. It's a digital code. However, the judge did find that direct sales to institutional investors were investment contracts. Crucially, programmatic sales on public exchanges to retail users were not considered securities offerings. This distinction is exactly what the Clarity Act aims to formalize for the entire digital asset industry. The goal of FIT 21 is to provide a clear path for tokens to transition from being SEC regulated to CFTC regulated as they become decentralized. Without this legislation, many fear the U.S. will lose its competitive edge to regions with clearer rules, like the EU or Singapore. Regulatory clarity isn't just about lawsuits, it's about allowing developers to build without the constant fear of litigation. This breakdown focuses on structure and law. We're looking at the foundation of policy, not price speculation. Understanding the Clarity Act and the XRP ruling is essential for anyone navigating the future of U.S. crypto policy. Thanks for watching. Stay tuned as we continue to track the evolution of digital asset law in America.